Can we keep you losing everything all of the time? Rethinking everything all of the time. Evil is deceitful and the truth is hard to find. Leave you searching everywhere all of the time.
Woo! Baby, did this song hit so close to my soul that I gotta leave the link in the description below. That bipolar parody of, Mark Cuban's, your Kevin O'Leary's of the world, jamming all this information down your throat to only see bankruptcies around the corner. The influencers, the clowns like myself across the YouTube spectrum is just ruining your mentality in your life on the path to true financial freedom, financial independence, because you damn well know at the bottom of your soul what you have to do. You just gotta do it and sleep easy at night. Global market index funds, guys, Vanguard, S&P 500 index funds. No, you're not listening to Dave Ramsey and his growth-based mutual funds. You just got to buy the path of least resistance to wealth building here. And $500 a month over a 30-year period will damn well give you the path of least resistance to $1 million status. So it's always prevalent because I know you got an addiction in your soul, whether it's dividends or buying growth stocks or penny stocks, guys. We all have that itch, but no more than 10% of your portfolio if you don't want to blow yourself up. Now, I'm giving you this advice as not financial advice because this isn't exactly what I've done since the inception of this YouTube channel, but I'm a clown. I have been for 15 years. I was a full-time magician. I got no degree in financial advice. If this clown was still able to outperform every idiot we're about to talk about, including the likes of the ARK Innovation ETF, your Kathy Woods and your Warren Buffetts of the world, which is why in this video I'm going to try and share with you what I think is going to be the true indicators that are going to show signs of the bottom in the market we're currently experiencing. But first and foremost, meet Kevin, guys, the dude that gloated so damn hard about buying or selling the tops, buying the bottoms, and then all of a sudden is loading back up on the only stock that made him any money, because everything else he suggested, if you held, you got devastated. If you turn the Meet Kevin indicators off and you went away for a month, you come back, you'd have lost everything after he flip-flopped on you, calling himself a diamond hander for the longest time. And now he's trying to convince you to buy his power pricing ETF. He wants to drag you down with Tesla stock because all of his money is basically in Tesla and Apple. If these things get devastated, he's just going to be nursing you like a cow for fees all the way down, because goddamn, these fees have a lot of high expense ratios with them. I don't think I got anything against Tesla. I just don't think you should be loading up on an ETF with such a high fee that's so damn concentrated, right? But let's talk about Jeremy. Jeremy, financial education, the gambler, the dude from Vegas that lives and breathes the soul of Vegas on his YouTube channel, over leveraging crazy, speculative, low float, volatile companies that probably ruined your life. Not his. He's still a millionaire. Even though he lost millions, you probably went to damn near zero because you don't have the kind of money to lose this guy does. And, he admitted, I'm going to change my ways. I'm not going to be buying these low float, crazy ass companies. I'm going to buy things of cash flow, things like Google. He's obviously looking at larger cap companies, but at the same time decides that he's going to go pro shares ultra short the Dow 30 ETF, which, what? I need to protect myself from the downside. I'm going to triple leverage up. Now that the markets are in turmoil, rather than doing it when the markets were flying, when it would have made sense to actually do some downside protection. And why not just do put options? You're rich enough. Protect yourself by cash flowing to the downside, and if it drops heavy, you get to buy the companies you love at the price you want. Why would you triple leverage? This is just going back to the true sign of, I need to make triple leverage the money if I'm right here, and if I'm wrong, this is only a small percentage of my portfolio, blah, 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 blah. Anyways, and then you got things like everything money, the value investors, nothing even comparable to the likes of the value investing of the Warren Buffett, and everything they picked have been just as devastating as anything of the other YouTubers we've discussed here. But they want you to pay a monthly fee for that, $29 a month, $79 a month, come chat in our chat groups, guys, even though that money invested would cost you like $100,000+ over a 30-year period just investing in these index funds. And they always tell you buy the indexes, but come pay us at least a little bit of that monthly fee. But anyways, it's just very bipolaring listening to all this stuff, and it's going to drive you bonkers, especially on days like today, folks, when we thought we were getting those rally backs. People get excited, and what did I tell you? What did I tell you? I don't trust these rallies. They're all hopium rallies. The market, from a guy that was so overbearingly bullish, which I still am in the long term, because we're seeing the value creation of a lifetime when it comes to innovation, genomics, AI. I don't know if you're using beta.open.ai, but I'm literally building websites and writing code off an AI generated machine, saving me hours of time. People don't even know that exists right now, which is kind of mind boggling to me. But these technological revolutions are going to add crazy market cap values into the future to all kinds of companies. and you need to be cost averaging into them. Easiest way, S&P 500 index, folks. But in this meantime of a down period, I want to outperform these markets. Me personally, I don't know what you're doing. You don't have to, but I want to catch more or less the bottoms and be buying these when they're a lot more pressured. That's what you've seen me do through October. I don't have shorts on the market. I'm not looking to do put options or anything like that. I'm just looking for when I see bigger dips in the market and to be buying them when they're a lot heavier. For the S&P 500 VOO, for example, I don't want to buy this recent aggressive kind of rally we've seen since October. I was buying the October dips. So let's let it cool off a little bit and I'll start cost averaging back in, maybe even likely toward the end of the month if we get another few days of these good couple percent drops. I mean, these are pretty marvelous, but what's going to be the true sign of the bottoming in this market? What is the telltale signs from past recessions? History does not repeat, but it does rhyme. And I think one of those things, first and foremost in a market like this, is going to be the bottoming of margin use. So taking a look at FINRA statistics, this is something I've talked about a lot. We saw all the leverage unwind from the crypto markets. Devastation, right? Like absolute devastation. That's largely what's impacted a lot of the stock market with small cap based companies, because a lot of people were leveraging up. I mean, you know, if you got 100 grand in there and the bank's going to leverage you another 50,000 and you're seeing these things go up 10, 20, 50, 100+% in a year, you'd be an idiot not to leverage a bit of the bank's money, or at least so people thought. Something that I've never recommended. I think I've done once in my entire life and it worked out, but I'm too scared to ever do it again. But taking a look, guys, from January of 2022, you know, look at this. We've gone from $829 billion in leverage, almost getting close to $1 trillion, down to $649 billion. And month over month, this is continuing to decline. We saw a little bit of a hiccup to the upside when people got hopeful in the summer, but so long as this keeps going down, I don't think we're going to see the bottoms of the market. Once this thing levels off and there's enough confidence for people to say, hey, this is time to start using leverage again. Not that you should ever do that, but when people start doing that, that's going to be a sign that the market, I think, is truly bottomed out. Another thing, ironically enough, I think when jobs start getting lost to an excessive extent that the Fed starts taking notice, that will be another sign of the bottom of the market. Super counterintuitive. And when we saw a huge amount of unemployment spike, guys, this was right around the bottom of the market in 2009 and 2010. We kind of saw it in the March 2020 crash as well, when all of a sudden, you know, unemployment just went through the roof, and that was right around the same time the market's bottomed. And right now we ain't there yet, baby. I think what's going to happen is once the Fed's done increasing these rates, they put so much pressure on the housing market that people with variable mortgages, mortgage renewals coming up that can't afford it, all that stress starts happening because you lost your tech job. You're seeing some pressures elsewhere. And again, that might not happen. It's very kind of hard to tell if we're going to see a soft landing out of this recession or we start seeing some bumps as the unemployment rate starts to rise. But as unemployment, if we do see a spike, I'm very likely sure that the markets are going to tank a bunch more and the Fed's going to start pivoting and they're going to start saying, okay, we'll start easing up on interest rates. If anything, we'll start lowering them. And that could be another 6, 12 months. Who the hell knows really if that's even going to unfold. But these are like the two primary indicators that for me personally, as somebody that likes buying the dips, that wants to see indicators toward the bottom, to continue aggressively buying when it makes sense from a fundamental standpoint. This is kind of what I'm personally looking at. And again, I'm not advising people to do this. It's just that
I didn't get that. Could you try it?
This is not something I'm advising anybody to do, but if you want to follow along, consider subscribing to the channel, because I do announce every time that I am buying the index funds, you know, whether it's VDY, the S&P 500, because like I said, I went super aggressive through October, invested like 15 or 20 grand. I've got another 15 or 20,000 that I've recently stacked up that I'm just being patient. I'm just going to wait into the end of the year. And like I said, as this starts to pull back, I'm going to start deploying. But I'd love to know what you think in that comment section below.